EGON von Greyerz, the dollar only has to lose 3% more in value for the US to follow Venezuela. EGON says the dollar has already lost 97% of its purchasing power. He rests when EGON says the dollar is virtually guaranteed to lose the final 3%. Will this be the fall of falls? 10 years after the Lehman collapse, will we again have an autumn of shocks in financial markets? The odds are very high. Overstretched stock markets look extremely vulnerable, including 13 recent Hindenburg omens for the U.S. market. The dollar could soon be on its final leg to oblivion, and U.S. Treasury bonds on the verge of a major fall that will eventually lead to hyperinflationary yields like Argentina and Turkey in the 20% plus region. Silver lining and bargain of a lifetime. There is always a silver lining, of course, and a golden one. Silver and gold, together with precious metal stocks, will soon start an extraordinary journey to levels that few can imagine. The undervaluation of the sector is best represented by the XAU Gold and Silver Index. At inception in January 1979, this index was 100, and today, after 4 decades of inflation, money printing and credit expansion, the index is standing at 63. It is different today. The final moves before a secular turn in world markets are often emotional roller coasters. Many investors know, at least subconsciously, that markets are overstretched and can turn at any time. Since central banks have consistently saved investors in the last few decades, why wouldn't that continue? Stock market bulls might be apprehensive after a 9-year bull move, but very few are prepared to get out. Greed and recent experience tell them that the market always goes up. Very few know that the market fell 90% in 1929 and 1932 and took over 25 years to return to the 1929 level, and even if they did know, it is different today because Forex market $6 trillion per day of worthless paper. Forex is the biggest market in the world with almost $6 trillion daily volume. So in just over 2 weeks, there is more currency trading volume than global annual GDP. It is of course a market with only paper trading and no physical settlement. Interestingly, Deutsche Bank has 20% of all Forex volume. No wonder that bank is more exposed than any other bank. Global daily Forex volume is 200 times the daily volume on the New York Stock Exchange. The value of the currency, whether it is dollars, euros, yuan or yen, has a massive bearing on people's standard of living. But very few understand this, mainly because no government tells their people that they are consistently destroying the value of the currency. The best way to protect against the constant erosion of the currency is to own gold, which is the only money that has survived in history. With no shackles, central banks have had unrestrained freedom to manufacture fake money by unlimited printing. 5,000 years of history and tradition as the only money that has survived has given gold total supremacy as king money. No paper money can ever make that claim. It is pitiful how emperors, kings, and central bankers have all, when government coffers were empty, resorted to making fake money, which by definition is always worthless. But just as no one dared to point out that the emperor was naked, no one today dares to say or understands that the whole financial system rests on a foundation of nothing. The bankers and the powers that be have a vested interest to keep this going, as they are major beneficiaries. Ordinary people haven't got a clue what is happening. They see prices going up, but they think that this is normal. Whatever Nobel Prize winner Krugman says, paper money doesn't fulfill the basic criteria for real money as a store of value. What ordinary people don't understand, because governments suppress the truth, is that the value of their money is constantly being debased. Just look at the US dollar since 1971 against gold. $35 bought an ounce of gold in 71. Today an ounce costs $1,200. That is a 97% devaluation in 47 years. All currencies have lost 97 to 99% against gold since 1913. USA will follow Venezuela and Argentina. Americans are not quite yet in the same boat as the Venezuelans, who have lost 99.9% on their bolivars this year only. And Argentina is on its way to do the same, and so are many more countries. What is virtually guaranteed is that the U.S., with its massive debt and accelerating deficits, will end up in the same situation within the next 7 years. With a 97% fall of the dollar since 1971, there is only 3% to go. But as the people in Venezuela have discovered this year, that final fall involves a total destruction of the currency and also of the economy. It also destroys people's lives totally as they struggle to survive physically and financially. This is the inevitable consequence of socialism. You always, without fail, run out of other people's money. And since socialism gradually takes over in country after country, the economic collapse that is now taking place in the periphery Venezuela, Argentina, Brazil, South Africa, Turkey, Indonesia, etc. will spread at a fast pace to all emerging countries and then on to the Western economies. Thus socialism is a guaranteed route to hyperinflation. It is only a question of how long it takes before you get there. A printing press can never create real value. Since gold is the only money that has survived throughout history, and the only money which has maintained purchasing power, the corollary is that all fiat currencies are fake creations of governments with no underlying real value and no real counterparty. A printing press can hardly be considered as a solid counterparty, nor can a government that just issues debt instruments whenever it runs out of real money. Thus paper money is no better than the $1.5 quadrillion or more of outstanding derivatives. Both these instruments will reach their intrinsic value of zero in the next few years. Don't lend your bank money without collateral. Since no bank will survive in its present form, people need to think seriously if they should lend the bank any money. Bail-ins will certainly be back. Personally, if I lent the bank my money, I would ask for collateral in physical gold. With bank leverage up to 50 times, how can anyone deposit money with them without taking security? With the current state of most banks' loan portfolios, no bank would stand today if they had to provide properly for all non-performing loans. And that is today. When credit losses increase, central banks will crank up the printing presses, but this time it will have no effect. You can't solve a debt problem with more debt. Financial system an incurable disease. In any case, the world financial system has now got a serious disease that can never be cured. Rather than adding fuel to the fire, the only solution is to let the fire burn the whole system to the ground. That will get rid of all debt, and that is the only way to clean up the gargantuan mess that governments and bankers have created in the last 100 years. Let the sick forest burn down so that fresh and strong new shoots can develop. The problem is, of course, that when the debt implodes, so will all the assets that were inflated by this debt. That is why within the next 7 years we will see the biggest wealth destruction in history. Sell consumerism and buy hard assets. So let us come back to the silver lining and end on a positive note. In every crisis there is opportunity. The Greek word for crisis means to separate or sift and only keep what is worthwhile, and this is what the investors who want to survive the coming crisis must do. Get rid of all bubble assets and buy hard assets. The chart below illustrates it perfectly. Since the IPO in 1997, the Amazon stock is up 1,550 times, or 155,000% against the XAU Gold and Silver Index. That the reverse will happen, and the XAU will be up 155,000% against Amazon by 2025 might be possible, even if it is hard to imagine today. What is clear though is that the bubble assets have had their run, and their fall will be brutal. Everyone must draw their own conclusion. Are the likes of Amazon and Apple the road to salvation, or is the best way to survive the coming crisis to own the most unloved and undervalued assets in the world? Most people will make the wrong choice. Best not to be one of them. Falling dollar keeps gold sell-off in check. You might not know it by just looking at the net change of gold futures today, but it is dollar weakness that is keeping the current sell-off in gold curtailed. Currently, the most active COMEX contract is trading up $3.60 on the day and fixed at $1,211.90. This modest rise is occurring in tandem with strong selling pressure on the US dollar, which has taken the index almost of 1% lower with a net decline of 0.669 points. As of 4 p.m. Eastern Standard Time, the dollar index is currently fixed at 93.445. The Dow and S&P 500 closed at a new record high today, the first new all-time high in the Dow since January 26. This bullish market sentiment certainly favors the risk-on asset class. Bullish sentiment in U.S. equities certainly is in competition for investment dollars, with the safe haven asset class pressuring both gold and silver pricing. If not for dollar weakness today, we would be seeing both gold and silver close moderately lower. Spot gold is currently trading up approximately $3.20 on the day and is fixed at $1,206.90 per ounce. On closer inspection, normal trading today has resulted in moderately lower gold prices, leading to a decline of $5.10 per ounce. However, once you factor in dollar weakness and add $8.30 of value per ounce, gold closes positive in trading today. Gold closed at its highest price point in 3 weeks as a result of today's $3 gain. According to Reuters, the Federal Reserve bought $1.1 billion in mortgage bonds during the week of September 13th. At the same time, the Fed did not reduce its balance sheet of assets. The Federal Reserve bought $1.133 billion of agency mortgage-backed securities in the week from September 13th to September 19th, compared with $869 million purchased the previous week, the New York Federal Reserve Bank said on Thursday. Although the Fed is on record as having a monetary policy which is reducing its asset balance sheet, which swelled to $4.5 trillion at the height of quantitative easing, along with small and consistent interest rate hikes, this move might be signaling a subtle change in Fed action. It will be interesting to see if the Federal Reserve statement released following next week's FOMC meeting details additional mortgage-backed security purchases in the future. Gold eases on firm dollar but heads for first weekly gain in 4. Palladium hovers near 5-month peak touched on Thursday. Platinum hits 6-week top. September Fed rate hike already priced in analysts. Gold prices edged lower on Friday as the dollar firmed on persistent concerns about an escalating trade between the United States and China in a week where both sides slapped new tariffs on each other's goods. China hopes the United States will show sincerity and take steps to correct its behavior, its Commerce Ministry said on Thursday, amid new levies in a long-standing tit-for-tat dispute. The dollar's status as the chief reserve currency makes the U.S. currency the prime beneficiary of concern over trade conflicts on bets that the United States has less to lose from the dispute. Spot gold fell 0.7% to $1,199.17 per ounce after touching its highest since September 13th at $1,211.02. But the metal was still headed for its first weekly gain in 4. U.S. gold futures were down 0.6% at $1,204.30 per ounce. Mitigating further losses in gold were views that new U.S. and Chinese tariffs were set at lower rates this week than expected. The fact that concerns eased a bit this week weighed on the dollar a bit, but that has reversed, and so that is why gold is easing, said Forex.com analyst Fawad, adding that gold was facing resistance between $1,205 to $1,215 per ounce. The dollar rose against a basket of major currencies, making gold more expensive for holders of other currencies, while equity markets and bond yields rose. Investors are awaiting next week's Federal Reserve meeting, where the U.S. Central Bank is widely expected to raise benchmark interest rates. Meanwhile, hedge funds and money managers cut their net short position in COMEX gold and silver contracts in the week to September 11th. Investment bank Goldman Sachs slashed its 3, 6, and 12-month gold price forecasts, but said there were signs that fundamentals were starting to change, with a recent weakening of the dollar and a rebound in Chinese and Indian gold purchases. Among other precious metals, spot silver rose 0.6% to $14.35 an ounce after rising to 2-week highs of $14.41. The gold-silver ratio, which measures the number of silver ounces needed to buy an ounce of gold, is at a record high of 83. This has pulled more investors into silver, which offers more value, as the current ratio is higher than the historical 5-year of 72.5, Inbank said in a note. Palladium touched its highest since April 19th at $1,056.72 per ounce and was up 0.5% at $1,055.22 an ounce. Platinum hit its highest since August 9th at $838.40. Sterling plummets on Brexit fears, lifting dollar. New York, sterling plummeted on Friday, driving the US dollar up after British Prime Minister Theresa May said the European Union must supply an alternative Brexit proposal, saying talks had reached an impasse after the bloc's leaders had rejected her plans without fully explaining why. The pound GBP equals was down 1.5% on Friday, set for its biggest daily loss since June 2017. The dollar rose on the back of the pound's move, rebounding from early lows, but was still on track for its biggest weekly drop since February, as stronger equity markets and rising bond yields fueled a rush to buy riskier assets. At a summit in Austria on Thursday, EU leaders said they would push for a Brexit deal next month, but rejected May's Chequers plan, saying she needed to give ground on trade and arrangements for the UK border with Ireland. Sterling bears are out in full force. BVE pushed the pound quite aggressively down this morning, said Dean Popplewell, chief currency strategist at Honda in Toronto, and it looks like they want to push things further. The dollar index rose 0.36%, DXY 94.229 as investors consolidated positions before the weekend, but the greenback was still set for its biggest weekly drop since February. On the back of it's interesting, the dollar got a bit of a bid as well. The trade woes in the last 48 hours took a bit of a backseat, and it did allow some of the risk takers to set their sights on some of the other G7 currencies, said Popplewell. A sell-off in the dollar that began on Thursday gathered steam overnight as investors ramped up bets that the U.S. Federal Reserve will be near the end of its rate-rising cycle, after an expected increase next week. Market expectations are for approximately 2 increases to U.S. interest rates next year, and Russell Investments said that medium-term recession risks in the U.S. economy are now elevated, pointing to a number of indicators such as a tightening labor market, with trade war concerns receding, and emerging market central banks led by Turkey taking measures to stabilize their currencies. Investors pushed up the euro to the $1.18 line for the first time in more than 3 months during the European session. The dollar's bounce, however, pushed the single currency EUR equals back into the red at $1.175. Reporting by Kate Jagweed and Saikot Chatterjee. Additional reporting by Shinichi Saoshiro in Tokyo. Editing by Andrea Ritchie.